On today's podcast, I've got Sam Roberts, who is the Director of Investment Consulting at Cartright. Most keen Bitcoiners probably recognise the name of that person and that company from a news article back in October last year when Cartright were the first company to onboard a trustee to have 3% of their pension funds invested in Bitcoin. Touch on that through our conversation, but if the name rings a bell, that's probably the reason why. Thanks for coming on, Sam. It's great to have you.
Yeah, pleasure. Thanks for the invite, Gary.
Hopefully the listeners will stay on, even though there's a chartered accountant and an actuary. It's probably not... Sounds like the start of a really bad joke, doesn't it? But
don't put that in the blur.
I'll leave that out of the headlines, but hopefully it will give. Hopefully we can put on a better performance than expected from a chartered accountant and an actuary. But I don't think we're stereotypical accountants and actuaries, are we? Let's put it that way.
No. I don't think early adopters of anything can really be stereotypical. It's sort of
True. Maybe let's not say we're mavericks, but maybe just not quite stereotypical. Right, so the first place I usually start with my guests is just to ask them their earliest memories of money. Sam, what was that for you?
Oh, well, that's a good one. I think it might have been buying the Beano for 20p. That seems like a long time ago.
Yeah, I used to love the Beano.
Local corner shop.
And was that with pocket money? Was that pocket money, or was that kind of mum and dad giving you the 20p to
yeah,
go
I
and
think
get
it was. Or, I was passing my dad, so we'd buy on the way through. But it was it was always the Beano rather than the Dandy for some reason.
Yeah, I was the same. There must be something in that. I don't know what exactly, but yeah, Dandy never really did it for me either. And then did you evolve onto Viz as you got slightly older?
No, not really. Not really. There was probably a copy passed around at school that I vaguely remember. But no, that was moved away from the comics, I think, at that point.
Yeah,
onto the study books.
Like a good study of the actuary in the making that you were. So what about through your teenage years then? What kind of financial influences did you have on your life?
I don't think I had much. I don't think I was particularly thinking about money. I come from a family where we didn't particularly have much money, but I didn't feel at the time that I wanted for anything. So that was just what you're used to, and it's all fine. You do what you do, and I was in scouts, and I played in the scout played trumpet in the scout band, and other sort of things like that. So I kept myself busy. Ate sweets, read comics. It was just sort of as far as I was concerned, normal. Worked at McDonald's. Maybe that was my first. Oh, I did collect glasses at London Irish Rugby Football Club because that was near where I lived. So that was my first time of working. Did that for a season. That was just on game days. And then graduated to work at McDonald's.
And was that influence from your parents trying to persuade you to go out and kind of earn some money, or was it just something that you wanted to do so that you could have money to spend on things?
I think more the second, in that if I wanted money to spend, they didn't have it, so I'd have to go out and earn it. It was quite a simple equation.
And were you more of a spender or saver or a bit of both?
I think I just spent what I had. Just spent what I had, and that sort of carried on through university, where essentially I worked every hour that God would send during the summer holidays, the Christmas holidays, Easter holiday, and then when I went back to uni, that was my money to spend, and I normally spent it all.
Beer money.
Exactly, yes. £1 a pint felt like it went a long way in those days.
Yeah, well, yeah. So that's, to many listeners, that will be a fond memory, or for the younger listener, they won't believe, they'll think you're making it up, saying that pints were £1, but I remember those days. So what made you interested in becoming an actuary then?
I didn't know what to do, and I went to the careers office, and I was good at maths. Went to the careers office at uni, and I said, what should I do? And he said, well, you've got a couple of choices. You could be an accountant or an actuary. I mean, there probably are other things out there. He was, maybe he wasn't very good at his job. But I thought, well, the simplistic way I looked at it and you might take offense to this, is that an accountant is more looking at the past and an actuary is more looking at the future. And I thought, oh, well, it sounds more interesting to look at the future, so why not do that? And so that's the path I followed. Managed to get a job halfway through my last year of uni, which, for good or bad, took the pressure off the exams, and started in that September.
How did your first steps through your career influence your feelings towards money? Obviously, doing a job like an actuary, you were probably earning a reasonable salary. So how did that maybe slightly more abundance of money maybe change your attitude towards money?
It didn't make a blind bit of difference. So you're right. You want a reasonable salary to start with. If you want that extra pint, it's fine. You can afford it. But I was still in the same mindset, I think, where money comes in equals money goes out. We used to get luncheon vouchers as well. If I was getting a little bit close to the wire towards the end of a month before payday, you may remember that checks had a 3-day clearance. So you could pay for the round 3 days before with the check, knowing that you wouldn't be charged for an overdraft because it would be paid when you got paid. So I think I didn't have loads of debt, I wasn't completely out of control, but equally just, what comes in then went out.
You spent to your means, as it were.
Yeah. And as the means grew, my spending grew.
Did you ever go down the trappings of designer clothes, flash cars, or was it just more lifestyle?
It was more sociable, I suppose.
Yeah.
So
That's quite rare for an actuary, actually.
Oh, thank you.
That was a conversation killer, wasn't it? I shouldn't have put that one in there. Quite a way into your career, Bitcoin came about. When did you first hear about it?
Well, so I started work in 1998, my actuarial job. And I was initially, as I say, money in equals money out. But then I got a bit better of saving as the decade wore on. And they got to 2008, and there's an actuarial exam on economics. You're just trying to pass the exam to get the tick in the box to qualify as an actuary. But there's nothing in Austrian economics in there. It's basically Keynes versus Milton Friedman, pretty much. And everything is in through that lens. So you end up, it's sort of a false situation where you think, well, there's Keynes over here and there's Friedman over there. If you take the view that they're the only 2 points of opinion, then obviously the reality is halfway between the two. So there's so much nonsense in everything I've just said there about how it's, but that's how the exam was set out. That was the syllabus. And so we got to 2008, and based on what I'd learned, and of course what I'd read in the papers before 2008 was consistent with Keynes and Friedman or some kind of blend. We went through 2008 and it doesn't make any sense. It does not. What I'm seeing in real life doesn't match what I've learnt in theory. And that actually has stuck with me for, until now and forever probably, is that you can talk round and round something in theory, whether in theory it should work or doesn't work or and all that. But what really matters is whether it works in practice. And so we have that, don't we, when people start talking, well, yes, but Bitcoin, how is it a store of value or how is it a medium of exchange? Okay, you just told me lots of theory. How about we look at what really happens in practice with real people? But in my industry, there's quite a few people who struggle with moving away from the theory, which is a shame, but that's just the way it is.
Yeah, it's interesting, isn't it? Because there are multiple real life examples of where existing theory is completely shot to bits. As much as some of those academics will try and rationalize it or explain it away, they'll still come back to that original theory, even though it has been proven on multiple occasions not to stand up to any real scrutiny. And it's still being taught at university now, isn't it? If you go to university and do an economics degree, I'm not sure you're going to get a lot of Austrian economics in there, if any. I don't know. As far as I'm aware.
My son has just completed his GCSEs and he was recently choosing which A-levels he'd like to do next year. And so I was quite interested. Obviously, there was a day where we went round and talked to the teachers about what they thought about all the different topics.
Yeah.
I didn't start a fight, don't worry.
I was going to say you were
And
that dad, weren't you?
one of those people. No, I don't think I was, but I was keen to listen to, okay, what's in the syllabus? And basically it's the same as my actual exam. I mean, obviously, it's a bit bigger than the actual exam in terms of what it covers, but it's basically Keynes versus Friedman. And I did ask about Austrian economics and so on, and I just got a blank look, which is worrying. But, maybe things will change.
Without getting too political on that, though, do you? Well, I suppose it's a slightly loaded, inferring a slightly loaded question there. But do you think politics is what is holding that back? As in, government, it's not really in the government's interest of any colour government to start to educate students on Austrian economics when they don't live by those rules. They live by the rules that have been taught as fact for so many years. It just seems crazy that they're still, those same foundations are still being taught, even though, as we just said, they've been proven wrong on dozens and dozens of occasions across different countries, continents, generations, etc. And yet they're still being taught as this is economics.
I mean, maybe it was different 2 or 3 generations ago, but now I'm assuming that you've got teachers that were taught that and learnt it, and therefore they're passing their knowledge on. I mean, we can criticise that it's not broad enough, but I think most people are just doing their job and trying to do it to the best of their ability, and they've been told that this is the syllabus that you teach to. So it's actually not, I wouldn't really blame the schools, actually, because the syllabus is set by, well, more centrally, isn't it? So, I mean, maybe there is some influence there, but it's probably more that, again, the people who are setting the syllabus, that's what they were taught. So they're just passing the knowledge on. But I do find it strange that people can't see that this theory that I've learned has been disproved in reality. And the sensible thing to do would be to question whether the theory is correct. But instead, it's trying to come up with excuses why reality is wrong, which is a weird way to think about things. But
Definitely, I think it's excusable for the general public, to expect them to understand the differences between Austrian economics and Keynesian economics is obviously a massive stretch. But I just find it slightly odd that someone who has a profession to actually teach economics wouldn't scratch that itch and just have that curiosity that so many of us as Bitcoiners, or even non-Bitcoiners who have, done more research into economics, have suddenly thought, hang on a minute, this stuff that everyone's being taught doesn't really stand up to scrutiny. But yeah, this is why the stuff that Claire in Loch Lomond School is doing with Saifedean Ammous just sounds amazing. Hopefully they can fly the flag for proper economics teaching, and then maybe that might spread slightly more widely.
hopefully, fingers crossed.
Yeah. So then Bitcoin. Then so we got onto the economic side of it, but then we didn't quite get up to how then that evolved
That's right.
into Bitcoin.
So 2008, so things did not feel right. I had this urge to trying to find an answer or answers, went in various different directions. And that's when I stumbled on the Austrian school. And it was like a light being turned on in the room. Suddenly, I mean, the Austrian school is a huge amount of detail and angles they go into on all kinds of different matters. But in terms of their approach and their thinking and their explanation of the global financial crisis and all that stuff, it was like a light being turned on. So that was fantastic. That was a real moment for me. That naturally led to me thinking about gold. So we're talking here in 2010 sort of time. Naturally led me to what is money and gold. And I would have then in that sort of time probably called myself, well, I think I would have called myself a gold bug. It made a lot of sense. But there wasn't any other choice. Okay, we're talking 2010, but I hadn't heard of Bitcoin at that point. And then I think I did hear of it, maybe 2011, 2012, but dismissed it out of hand with the benefit of hindsight. Obviously, I wouldn't have done that. But then it had another bull market in 2013. And my thinking was it hasn't died. When I previously heard of it, I think it had gone up once and then fallen back down. You think, okay, well that was sounded an interesting idea, but it obviously wasn't meant to be, and I don't really understand it. 2013 was, it's not died yet. Maybe there is something here. What I'll do is, it's not so much about trying to work out the theory, it's trying to come back to that theme. How does it work in practice? Does it really work? And so I sort of dabbled a little bit with some, trying to buy some back in the end of 2013. And that was quite interesting because you're getting something that really works. And then the price collapsed. And I thought, oh, okay, well, that was interesting. Never mind. Forgot about it. And then came back to it a few years later when, well, in 2017, of course, it had a run up in price. And you think, oh, that's interesting. It's still not died. And then that takes me through to really 2021. So a lot happened in 2020, obviously, but because a lot was happening generally, but also in financial markets, I was actually extremely busy. So didn't really have time to think about much else. It was then when 2021 came round, that I realized, the Bitcoin price, it crashed and then it recovered. So again, it drew my attention. It was during 2021 that I then had chance to do a deep dive on trying to understand it better.
How does that translate into your kind of TradFi world, and how can you even comprehend starting to integrate in some way, shape or form Bitcoin into your profession?
Well, I won't deny it wasn't sticking my neck out in our world, but from a personal point of view, what helped me sort of middle of 2021, what helped me to finally get it to my brain to click sufficiently to felt that I understood Bitcoin, there were two particular things. So one was I finally got around to reading the Bitcoin Standard. Excellent book. It's on the academic side, but the reason why it really worked for me is because it brought together the building blocks that I'd built up over many years, Austrian economics, gold, and what is money, and put them in a way that allowed me to make that transition to why Bitcoin much easier. So for whatever reason, that was one of the things that really helped. The other thing was NFTs. I dabbled a little bit, and that helped me to understand that there's basically zero value in NFTs. There might be a bit of hype. Someone might like a particular picture, and that's fine. But from an investment point of view, there's just basically zero. But it was only by dabbling that really helped it to click in my head. So you got those two things coming in it really from different directions. So when I got through that, it was clear in my head that if we're generous, there's some stuff in crypto, in inverted commas, which may have some technological use or may not. That's to be determined. However, the potential for Bitcoin to surpass gold and do a much better job, particularly coming at it from an Austrian economics perspective, is absolutely huge. And so I did what I think we all should try and do, which is focus on where there is the most value. And so that for me was definitely Bitcoin. I mean, not only from a return point of view, potential return point of view, but also from a risk point of view. I was at that point comfortable that, there may be the odd extreme scenario, but basically it's very, very difficult to kill Bitcoin. Whereas the other stuff could easily get overtaken in a heartbeat and then become worthless if it isn't already.
Yeah.
So that was late 2021 that it felt all in my mind along those lines. And then February 2022 came around. So that was when Russia invaded Ukraine. The Russian government had $300 billion worth of their foreign government bonds that they owned, or at least that they thought they owned, were frozen. So what that did, in my mind, was immediately bring back explicitly counterparty risk back into government bonds. And this is also quite, maybe not interesting for everyone, but potentially interesting because pretty much all the models that we use in certainly in my industry, in the pensions and investment industry in the UK, but worldwide, use the assumption that government bonds are risk-free. What they really mean is risk-free. If you pursue that angle, it's, well, they're risk-free in nominal terms, i.e. you'll always get paid £1 if you're owed £1. You just may not be able to buy as much with that pound. But I think the Russian government bond experience also brought in this counterparty risk, this sort of credit risk of government bonds as well. It depends on who you are. So if you fall foul of, or if you're seen as a bad actor by a particular government, and we're talking, particularly we're talking about Western governments here, then you may not get the returns on that bond that you thought you would get, because they'll just say, no, you can't have your money. So that basically undermines pretty much every model that is used in our industry. Anyway, that's a slight side point there. But
yeah, no, it's quite sobering, isn't it? And I think the other thing, going back to some of the things you said there, is around the reduction in how risky you felt Bitcoin was. But once you got through those hurdles, the likelihood of Bitcoin failing in 2013 was a lot higher than the risk of Bitcoin failing in 2022, because of how many attempts and failures to break Bitcoin had already taken place. And that's what I think some people that are newer to Bitcoin maybe don't quite associate when they see the price and say, well, I'm late now. There's no point buying it now because look how much it's gone up. But it's the risk versus reward ratio, isn't it? If you're buying in at 2013, there was a much greater likelihood that you could lose some or all of your money. It may not have gone to zero. And I know a lot of people would say, well, if it doesn't go to zero, it goes to infinity. But probably in 2013, it didn't quite feel like that. Whereas, you get to 2021, 22, almost like every block just reinforces the extra strength of the network, and the level of risk just starts to fall. And then if you're joining the dots with Austrian economics, gold, the issue with bonds, kind of it all just converges together to Bitcoin, doesn't it?
Yeah, it does. And partially gold in that. So coming at it from an institutional perspective, there are very few, well, probably no schemes, corporate pension schemes we're talking here, have any explicit gold allocations, but they will have exposure to multi-asset type funds, and some of them do actively use gold, and sometimes they'll look at it as essentially a form of money, and some of them won't. So they'll just look at it, what's the volatility, what's the expected return, and that kind of thing, correlations with other assets. So they'll treat it slightly differently. But some pension schemes will have some indirect allocation to gold, and so they're aware of it, and they are a bit more open to it. And so, a lot of people have grown up with only understanding gold, and I think I think it's a mistake, but I think there's still a lot of attachment to, yes, but gold is physical, and I think that's an error, in a 180-degree error, because it's physicality that holds gold back. If you could separate the monetary premium of gold and the physicality utility of gold, basically you'd get Bitcoin and some jewelry. So moving from it being a personal hobby, a personal interest, having that in my mind about being able to think straight about it, and then thinking, hang on a minute, this is going to be relevant for our sort of clients, but how do we position it? How do we think about it that's relevant for them? You can get the best technology, but it needs to be used in such a way that is relevant for that particular person or that particular organization. And the same goes for Bitcoin as well. So we spent a lot of time thinking about how Bitcoin could be used in so many different ways. We spent a lot of time thinking about what's our skill set? If we do try and do everything, basically we're going to fail at everything. So we need to focus, we need to specialize. Historically, where are we coming at this from? How does Bitcoin fit into that? And it actually became relatively straightforward then, having gone through that thought process. It's that institutional investors, like pension schemes, have a range of different assets to choose from, different types of equities and bonds and property and various other things. All we should do is add Bitcoin to the list of asset classes they could invest in, And then you apply the same type of analysis and thought process to Bitcoin that you do to everything else. And our clients have typically they've got a portfolio of assets, and therefore they might have Tesla in there somewhere, and that'll go up and down very dramatically. So they're not worried about volatility, or they shouldn't be worried about volatility, or if they are worried about volatility, they haven't thought about what they actually own, which is slightly concerning. But they've got a range of different asset classes, and they think about how does the overall portfolio perform in different scenarios, and that's how they think about things. They shouldn't be thinking about, I've got this little bit over here, it's going up and down a lot, does that matter? That was very helpful. And then when you look at, okay, well, we do on all the investment funds and asset classes that we recommend to clients, we do a certain level of due diligence on how they access each of those areas. So that it's no different for Bitcoin. However, we're not doing any, there's nothing silly going on. So there's no silly games, is what I like to say. So there's no trying to stretch for a yield or trying to get any yield for that matter. There's no trading or, there's no crypto. It's basically buying Bitcoin and holding it. Now, within a portfolio, and this client put in 3%, so use that as an example. If it goes up to 6%, maybe that's fine. If it gets to 20%, then it's not fine. So you have, and it's for a few different reasons there, but ultimately, if you're looking at an overall portfolio, it doesn't matter what the asset is, you can't allow it to get too large. So we do
Are there generic guidelines about that? So would the same be true of gold or bonds, or is it like if it's bonds, you can't have more than 50%?
So there is a rule, a regulation that says that corporate pension schemes should be invested predominantly on regulated markets. I mean, it's not been fully tested, but it's not been tested at all by the courts or anything. But in terms of the magnitude of that, a rule of thumb might be 15%. And some pension schemes do invest in non-regulated markets. So they might own a physical building. So that's not a regulated investment. So there's a clear precedent there that it's okay to invest in non-regulated assets. And you can make arguments to or for, but from our point of view, we're saying, well, look, let's treat it as unregulated, even though you might be able to make an argument that it is at some point. And therefore, we want to stay well below the 15. So that's one angle from a regulatory point of view. But there's also, which I'd argue is more important, is from an investment point of view. So I mentioned you do that overall analysis of the portfolio and you get comfortable that Bitcoin is adding value from a risk and return point of view, not taking value away, not adding too much risk in, which often is volatility, even though that's a proxy for risk. It's not a great long-term measure. But anyway, if your Bitcoin allocation went to 20% and you rerun the same analysis, the trustees of that pension scheme are not going to be comfortable with the answers. And so you can think in advance to say, well, okay, how big can that percentage get before the trustees are not comfortable? In which case, we need to make sure that we're comfortably below that limit.
But how does that, it interests me just to think, if you compare that to an individual, if they've gone down the rabbit hole of Bitcoin and they've put 3% of their net worth into Bitcoin and it's gone up to 20%, those kind of people are arguably more likely to say, I now understand even more about this Bitcoin thing than I did when I allocated 3%, and I understand it more, and it's now an increasing part of my net worth. I should be putting more in. Is it just literally because of the trustees of a pension fund can't be that orange pilled because of the responsibilities they have for looking after the individuals within that fund?
Where we are now, and particularly for these particular pension schemes that I'm mostly talking about, there's two different types of pension schemes essentially. There's defined benefit, where the employees of a company are promised a certain pound amount of pension when they retire at a certain age. It's going to get some pension increases probably, and there'll be a pension for their spouse when that member dies, and so that's there's about 5,000 schemes across the UK that are structured on that basis. and maybe £1.5 trillion worth of assets in those types of schemes. And then you've got defined contributions, sometimes referred to as money purchase, which is the employer and the employee put in some money up front. It's invested in some way. And then whatever it buys when someone retires, that's what they get. So that's thinking about things much more on a member by member or staff member by staff member basis. Whereas the defined benefit pension scheme can think more about, I've got a portfolio of assets, I need to provide lots of people with a pension from this.
Yeah.
This
and
this
it's purely
bunch of assets.
fiat, isn't it? So it will be based on, if it's a final salary or an average salary over a career, and then the company is liable to pay that person when they retire, make a number up, £35,000 a year, going up with CGI or whatever. So they need to make sure they've got sufficient fiat available to keep paying that for as long as that person's alive. And as you say, maybe when they die, it goes on to their spouse as well. So it's making sure they've got a big enough pot that can secure payment of those future liabilities.
And those, as you say, just to reiterate that point, those liabilities are denominated in pounds sterling.
Yes.
So they need to think about everything in the context of pounds sterling. And so they invest in lots of assets that are not denominated in pounds sterling. I mean, I'd argue Bitcoin is denominated in Bitcoin. But when we trade it, we need to sell it for pounds to then pay these pensions, which are denominated in pounds. And the same would go for equities or property that are held by these pension schemes. They need to ultimately sell them for pounds and pay the pounds out to pensioners. So I think that's the other thing. So you can do some calculations, and there's going to be some assumptions which we as actuaries think about, like how long people might live for. But essentially, you can do a calculation that says all these pensions have been promised. Roughly, how much do we expect it's going to cost now to pay all those pensions out? And obviously, you don't know the exact number because the future is uncertain. But you get a rough idea. And if you've got that much, depending on how it's calculated, that might be enough to pass the whole lot over to an insurance company as well. So you need enough return to get you to that magic number where you can pass the DB scheme over to an insurer, but you don't need any more. I think that's the crucial thing from a Bitcoin point of view, is there's no point. It actually works against you if you have too much Bitcoin in the context of how these people are investing, how these trustees are investing. DC, or money purchase, on the other hand, is a bit different in that there's no upper limit in the same way. You'll get whatever pension that pot of money will buy you when you retire. And for people who have studied and are very comfortable with Bitcoin, they may actually want to put all of that DC pension into Bitcoin. But as things stand, that's not a possibility anywhere across the industry as far as I know. And I'm fairly confident someone would have told me if it was. And again, just to reiterate, we're talking about corporate pension schemes here. We're not talking about, I know there's SASs and so on like that.
Yeah.
That's not an area we directly deal in.
And of course, you've got
really
and of course, you an individual. So I have a company pension scheme through my employer. I also have a SIP that I completely control myself, and is jam packed full of strategy and smarter web company, etc. So again, that's completely. There's no one else that's telling me I can or can't do that. That is completely at my own risk. Whereas my workplace pension, the most optionality I've got is to tell them my risk profile of whether I'm higher weight of global equities, or if I'm really against risk, then I put it all in bonds, which is just the most crazy thing. But there we go. That's the way the industry works. But yeah, I think it is a minefield for someone that doesn't even really know what a pension is or how it works. You've already just kind of peeled back a few layers of that onion and all those different schemes and pots and requirements. So, and the most interesting thing for me is with the defined benefits, is the aim of the game is to accumulate enough fiat to run the numbers past the actuary to say, we've got enough in here for make a number up, 100 people that are in the scheme that are going to retire and we think are going to live for this long and claim this much. And with the money that we've got in there and the returns we think we can make, that's it now. You don't need to contribute anymore. There's enough in there. Company A, you don't need to pay any more into your pension scheme. That's right, isn't
Yeah,
it? That's basically the
exactly. Yeah, exactly. So
target.
that's the DB. I mean, I think on the DC side, there will be, I mean, there's been a lot of attention on consolidation of that part of the industry. And, understandably, that takes a lot of people's time to do that. And maybe it's the case that therefore they haven't had time to think about the investment options that they're providing to staff and to members of that scheme. A lot of the options available now are multi-employer schemes. And so like you mentioned workplace pensions, that's a particular type. And DC Master Trust is another type. And so there'll be, I suspect, a competitive advantage for the first DC Master Trust to stick its head above the parapet and say, okay, we've got a lifestyle fund, we're going to add a bit of Bitcoin into that. That will get some attention. And you have a range of self-select funds that each member can choose from. We're going to add Bitcoin to the list in terms of what members can choose. And that seems a pretty low-risk way from the DC Master Trust, of dipping their toe in the water. Because if you say you add the option of a Bitcoin fund, then it's just testing what members want. And if no one buys it, a couple of years later, you just kill it.
Yeah, that's what I was going to say, Sam, is from conversations I have with a lot of people, some people are kind of vaguely aware they have a pension, but don't really know how much they've got in there, how much they pay in every month, what it's invested in. It's just it's not necessarily just burying their head in the sand. I think it's tomorrow's problem. It's, there's enough things on their plate today. The pension will come around at a later date. And then you factor in Bitcoin and you try and have a conversation with people about Bitcoin that aren't interested in it. And again, you've got the FUD, you've got it's complicated. We don't need to list all the reasons why people would say they're not interested in Bitcoin, but you almost compound those two things together. Pensions that people find confusing, boring, or tomorrow's problem, and Bitcoin, which is, I don't understand what it is and it doesn't seem real. And those two together, it feels like such a small percentage of the population that would go after that. Do you think that's the reason why maybe some of these schemes haven't pushed harder, or to actually get that in place? Or do you think it's more pushback from like the FCA or the regulations and the hurdles they'd have to go through?
I mean, some of it may be they say, well, I'm not interested, therefore why would anyone else be interested? It might be that. It might be that the FCA has muddied the water somewhat in terms of whether it's okay to buy Bitcoin or not. So they've made it difficult for some people. And I can understand why some people who are looking after other people's money would say, well, if the FCA is giving us some bad vibes on whatever this asset is, or something like this asset over there, then I've got so many other things to do. Why would I bother? Why would I take the risk? Why would I take the career risk? And maybe some of it is that they grew up learning at university or in the actual exams thinking that the only two forms of economics were Keynesian and monetarist, and they haven't realised that there's a bigger world out there. So there's going to be a mixture of reasons. They're big organisations and they've got lots of priorities, so it's a slow burn. But I hope that we can make some progress, and hopefully the ETNs coming online, whilst they won't directly affect, because in reality they're probably not going to buy the ETNs if they were to implement a Bitcoin fund. But it's more what it signifies in terms of the regulatory environment that probably matters more.
I use Strike to buy my Bitcoin, and every time I go into the app, it's got you can't get rid of it. The warning sign at the top says whatever it is the FCA tells them it has to say on it. You can lose all your money. This is high risk. So while the FCA has that stance, as you say, why would someone who's earning a good salary in a business, accruing their own pension for their own future, put reputational risk into sticking their neck out to try and back something that their FCA is saying this is really volatile and dangerous and don't touch it? So but then that is changing, isn't it? That is, the FCA is going to change its stance on that. So it feels like a bit like that 2013 to 2021 analogy of the risk reward. things are going in the direction of improving the regulatory approach to Bitcoin in this country, shall we say?
Yeah, I think so. And there's a whole roadmap that goes to, I think it's July 2026, a regulatory roadmap. So there may be further developments as we go through and into next year. I mean, ironically, that might be in time for the next bear market, but
That would not be a surprise, actually, would it? Although, again, we can go there. We don't have to, but there's an interesting discussion really about what that next bear market might even look like.
Who knows, right? I mean, I think that's why we've got things like this rebalancing mechanism that we use, so that for our pensions clients and other clients, and that would that helps to take some of the profits along the way, and just is a sensible way to go about it. I mean, I think there will be. I'd be surprised if there isn't a bear market. I mean, I think you've got the latest. There's always some big trend, isn't there? Alongside every bull market, people get excited about something, and sometimes there's some value in that something, and sometimes there isn't. Sometimes it's pure hype. So I mentioned NFTs earlier. I mean, basically, I think that was pure hype, no substance. But now we've got Bitcoin treasury companies seem to be the big idea, and that's quite interesting because there is substance there, but it's got to be done right. So you've got companies buying Bitcoin as a treasury asset. That's a sensible thing to do for a lot of companies. And some companies, 90, have got 100 million in their treasury. They buy 5 million worth of Bitcoin to add to that. They dip their toe in the water in that sense. It's just an overall diversified asset. Other companies will want to go further. But where we might see this bear market come about is if the Bitcoin is not held securely. So if the custody arrangements are not strong. And so we're working with one potential Bitcoin treasury company at the moment to help on the exchange and custody side of what they want to achieve. So that's all about exchanging for, without, keeping the transaction costs low, keeping control of exactly what assets are owned at any particular stage, making sure the Bitcoin is held securely, for a long-term strategy. So that's important. And so if I was to look across the industry, and let's say we get a bear market in a year or so, or start of a bear market in a year or so time, or a couple of years time, then maybe it will be because some Bitcoin treasury companies think they hold some Bitcoin, but for whatever reason they don't. It wouldn't be exactly the same, but it would hark back to sort of 2021, 22, when you had these large exchanges, FTX, Celsius, BlockFi, and those kind of things, where they didn't hold the Bitcoin. Well, you could argue they never intended to hold some of that Bitcoin. That's a whole different story.
I guess there it was that, I didn't have anything with FTX, but for argument's sake, let's say I did. I thought I had £1,000 worth of Bitcoin with FTX. FTX go down, and I realised actually I don't have £1,000 worth of Bitcoin.
Yeah,
I guess the analogy with the Bitcoin treasury company is I've got some shares in X treasury company co. And it's worth £1,000. I'm thinking, well, I've got 1,000. That company I bought shares in they're telling me they've got X number of Bitcoin, so I own my share of that. Then if it turns out they haven't, again, my shares are arguably maybe not worth this. It depends. If the company is only got 5% of its treasury, it's not cataclysmic. If it's a pure treasury company play, like a MicroStrategy, now Strategy, obviously if they're getting on for 700,000 Bitcoin didn't exist, that is a black swan event for Bitcoin.
Yeah. Although we just talked about it, so that's a grey swan.
Is that because if it can't be black if you've mentioned it? I've never heard that before. It makes sense,
if
though.
you know about it, well, I'm sure someone can correct us if we're wrong.
Okay.
But I'm pretty sure if you've thought about it, it can't be a black swan.
Yeah, that makes sense. I've never thought of that before, but that does make perfect sense.
So the I mean, there's going to be so one of the points there is that one of the assumptions is how quickly each Bitcoin treasury company can accumulate Bitcoin, and there's some reflection of that in the share price. That seems to be the way it's operating, and so it may just be they can't buy enough Bitcoin to justify their share price. There may be things like that, and then people lose confidence, or if Bitcoin falls for other reasons, then their share prices. There's a lot of unknowns about exactly how it's all going to work out. I mean, I think there's a couple of, there are businesses which, by buying Bitcoin in this way, actually support and help their existing business to grow. And, that's a very clear use case. If we look at it on a more sort of macro basis, then what I think we're seeing is Bitcoin treasury companies being one way in which bubble is moving out of fiat currency and the related asset classes. So this is the point that the monetary premium of certain assets, so where they're used as a store of value rather than for their utility value. So take your house for example. People buy houses because they want somewhere to live. That's a very sensible reason to buy a house. But they also often buy a house because they want somewhere to store their wealth. They've recognised subconsciously or otherwise that pound sterling or another government currency is a poor store of value. And therefore, they're going to have some money in that, maybe because they've got no choice. And it's relatively stable over short periods, but it's no good for long term. So people buy a bigger house than maybe they would otherwise be able to afford and take out a bigger mortgage, and effectively they're saving by paying a higher mortgage. You could see that. There's similar sort of patterns if you look at equities or bonds. People put savings into pensions. Where are those invested? Equities and bonds. So they're really, whereas if they have the choice of a better option, would they really have as much in a pension? Maybe not. So you've got a bubble, I would argue, in these key asset classes. As we move to a Bitcoin standard, there is going to need to be a way for that store value aspect to flow out of those key asset classes into Bitcoin. So the big question is, how does that happen? What is the funnel that's used for that value to flow? What path does it take? And so people will just naturally do this. They'll be looking for bridges, and if they don't exist, they'll build them to go from these asset classes where there's a monetary premium that shouldn't really be there if we had more of a choice, a better choice, and the better choice being Bitcoin. What's important is that these bridges are built securely and strongly to last a long time. There's going to be some bridges that are built just spun up overnight, and they're very weak, and they're going to fall down when any pressure is put on them. So that sort of goes back to, I think people need to be quite careful when they're getting into things like Bitcoin treasury companies and which ones they buy, and that's obviously a personal decision that they'll make for themselves. But there'll be other bridges that emerge over time, and we haven't figured out what all those are yet. But if I come back to actually sort of corporate pension schemes and pools of assets, we look at where is the value going to flow, where there's too much monetary premium that's going to flow to Bitcoin. It's all those asset classes that pension schemes invest in at the moment. It's equities and bonds and property. And so one of the ideas that we've been trying to help people to understand the risk is that money flows from the monetary premium that's already in those asset classes and flows elsewhere. How do you hedge against that risk? Will you buy some of the asset which is going to benefit from those flows, i.e. buy some Bitcoin? And you add it into your overall portfolio. So you are buying into a hedge. And not only that, but most hedges, you have to pay money. It's like an insurance policy. You pay money out every year to protect you against XYZ risk. Here you have a hedge that is effectively paying you every year. Well, not every year. On average, over a long period, it's almost certainly going to pay you because that monetization process and as it emerges as a more widely used form of money. So it's maybe a bit of a roundabout answer, but trying to tie together some of these different themes that we've touched on.
Yeah, I think the other thing that's interesting with what Michael Saylor's doing with strategy is all of these preferred stocks, with really trying to, again, you're probably quite well placed to try and articulate the kind of institutions and even individuals that they would appeal to, the likes of the Strike, the Strife, the Stretch, Stride. I think that's all of them. So all of these different, we don't need to go through them all in detail. There's plenty of other places people can find out. But in essence, it's hoovering up fiat to buy more Bitcoin to give the person that's bought that preferred stock either a variable dividend or a guaranteed dividend that is a lot higher than what they would get in either buying a bond or leaving their money in a building society earning 3 or 4% a year. When we go into the next bear market, there is a view that says that will probably coincide with reducing interest rates, which will make some of these preferred stock options even more attractive than they are now. So loads more fiat will flow into it, which will mean there's that natural buy pressure for more Bitcoin, which is going to suppress the depth of the bear market. Do you buy into that narrative, or is that strategy maximalist hopium playing out?
So I don't want to get into talking about any particular financial instrument or security because that'll get me into trouble. But the general concept there of that if a Bitcoin treasury company is selling equity in the market, it's drawing some of that monetary premium from that equity market. If a company is issuing debt into the market, then it's drawing it from the bond market, which is also a huge market. $150 trillion or something of that order. And so those are two ways in which to do it. And there's some ideas out there which I think are very, very clever around how Bitcoin can be combined with existing traditional asset classes, let's say, which effectively sort of do the same thing whilst working within the mandates that these professional investors have. So, for example, you've got asset managers that can only buy equities. So it's no good going along to them and saying, "Hey, you should add some Bitcoin into your portfolio." They just can't do it. It's just not possible. They need to be buying equities. Similarly for bonds and real estate and so on. But some of these structures are around lending money. So the investment fund itself would lend money to an entity, a company, or actually gets quite interesting if you look at things like local authority bonds, which we've given some thought to. Effectively, it's structured in such a way that Bitcoin is incorporated and the investor in that bond, so the investment fund in this example, gets some of that Bitcoin upside. And yes, maybe it's all paid in fiat because they can't hold Bitcoin in their fund, but they're getting that potential Bitcoin upside, and that gives them something new and different to invest into and potentially beat their peers and so on. And obviously it comes with risk and it needs to be structured in the right way. They need to think about things like the Bitcoin price volatility, etc. But there's some quite interesting things happening there, which are quite very early days, but it's along the same theme. You've got pent-up money, which shouldn't really be where it currently is. How can people benefit from its flowing from where it shouldn't be to where it should be?
Yeah. And again, conceptually, you might end up with, for retail, you could have a mortgage product that says, right, you want to borrow £200,000 to buy that £450,000 house. Let's make it 210,000 and put 10,000 into Bitcoin. You've then got a wrapper of a mortgage with some Bitcoin attached to it. Again, you could see the benefit over time that that's going up, which might mean you don't have to pay off as much, or it gets paid off quicker. Or do you think we're years away from that in the UK, or is that conceptually something that might happen in my lifetime?
Inception, I think it'll happen in our lifetime. I hope. Well, that says more about my lifetime than I think it does about it happening. But I don't think it's possible under the current regulatory framework in the UK. At least that's my understanding. So I did dig into this earlier this year to see, I was looking at it from a mortgage company perspective, so because obviously I focus on institutions, and say, well, actually, I'm thinking, actually, this could be an idea which they could benefit from, and their customers could benefit from. It'd be a competitive advantage, etc. But I don't think it's currently possible. I mean, I think there may be some scars from. Have you heard of endowment mortgages? They were quite prevalent in the sort of the 80s, the 90s. And they effectively did a similar sort of thing, which is a reason why this idea may not get off the ground, in that they effectively did the same with equities, or some equities and bonds and property. But the investment returns were never quite enough. Well, sorry, never quite enough. I'm sure they were in some cases. It very much depended on your timing. If you happen to need to pay off your mortgage in 1999, then it's probably okay. Yeah, so there's a bit of there's some battle scars there, I think, in this country in terms of buy an asset that is expected to outgrow your mortgage, and then you can pay off your mortgage. But I think the principle is a good one, and maybe attractive to some people.
Like with all these things, the people that probably need it the most are the ones that are completely unaware that any of this stuff even exists.
Yeah, I think that's right. I mean, it's one of the consequences of the FCA being sort of clamping down on this stuff without arguably really understanding it, or even understanding the difference between Bitcoin and crypto. If we'd had, you can imagine if we'd had a more sort of flexible environment in which to come up with new ideas, then it would be, these things would be packaged in such a way to take out some of these risks. If you try and cobble something together, it's never quite as good as if you've got it clearly packaged with everything thought through. And I think that's all we're really saying, is that there is, and it could be mortgages, it could be some of this bonds or equities, it could be pensions more generally. By packaging things up better and in a well thought through way by professional people who spend a lot. The economics exam aside, they spend a lot of time thinking about and learning about how these things operate, and they've got certain skill set. Let's apply that to the assets available within where we're allowed to do some innovation, and actually we could significantly change the prospects for this country, which seem a bit damp at the moment, to say the least of it. I mean, on the pension side, the key risk that people talk about is the concern that they're going to run out of money as they get older. And they buy annuities or similar products to try and protect against that. But annuities are very complicated, and they don't need to be as complicated as that. But one of the reasons they're complicated is because the insurer has to buy all kinds of, it's like the DB scheme that I mentioned earlier. They've promised to pay out a certain pension for as long as someone lives, and they have to invest in the assets to try and beat that or achieve that. Make the numbers add up, in other words. But it can be much simplified. The key risk that's being managed there is really pooling the chance that someone lives too long. So you have let's say you've got 10,000 people. Basically, they through a product, they come to an agreement that, look, none of us know how long we're going to live. Therefore, we'll all chuck some money into this pot, and the pot will just be paid out for the rest of all our lives. And if, let's say, we're expected to live a bit longer, then we'll get slightly less that year to try and spread that money out into the future. If we're expected to live a shorter time, maybe we can get the money a bit faster. But if someone dies, then that's unlucky for them. But whatever they would have got is then spread across everyone else. And so it's these kind of innovations which actually, when you put together with Bitcoin, and maybe there's a transition period where it includes putting it together with gold as well, while people who are retiring now get used to the idea of Bitcoin. It may be a younger generation thing predominantly. You put together the perfect money with some longevity pooling, and suddenly you've got an idea that is fit for purpose and sustainable, and doesn't rely on things like the insurance company always being there for you, or if the insurance company need to be bailed out in some way. So there's lots of ideas going on and being thought of, and I like to think in some ways that Bitcoin has been the inspiration for a lot of them.
Yeah, I'm sure it has. Are you going back to the company that put the 3% allocation back in October 24? I'm not aware that there's been any public announcements of companies that have done the same since. I'm not sure if there are, whether you're willing or able to say that there are. I'm sure there have been other conversations you've had. How's that landscape evolving since 8-9 months ago? What's happening now? Are those conversations more frequent?
So if I'll just give a little bit of the sort of overview of the landscape that we've got, right? So I mentioned earlier, we've got 5,000 DB schemes in the UK. Now, because of where markets are at, about half of them over the next 1, 2, 3, 4 years should be able to afford handing the entire DB scheme over to an insurer, and then that scheme leaves the company's balance sheet, and that is the ultimate objective for the vast majority, if not all, of these DB schemes. So what those 2,500 schemes should do is focus on getting to insurance as smoothly, as safely as possible. What they shouldn't be thinking about is how can we, do we need any Bitcoin? Do we need more equities? Do we need some other kind of risk within our portfolio? They should be reducing risk. They should be passing over to the insurer. So that takes out half of that market. If we look at the other half, the 2,500 that have got a longer time to go, maybe they do some calculations. They've got 5, 10, 15 years to go until they can hand over the scheme to an insurer. But of those, there'll be certain reasons why some of them don't really have a long time horizon. So they may have a 10-year time horizon to get to that insurance position, but they've got a big employer who could put their hand in their pocket and immediately pay for them to go to buyout. So there's a lot of uncertainties. It's 10 years in theory, but in practice it might be 2. And so therefore they shouldn't really be thinking about Bitcoin. And so you take out situations like that, and the back of the envelope numbers might be that maybe there's a few hundred DB schemes in total that should be seriously considered. And even then, not all of them will invest, but a few hundred. Let's say there's 400 or 500 that should seriously be considering it. So we're trying to have some of those conversations, and we're having some of those conversations, but it is a slow burn. A lot of those people, those trustees in charge of those schemes, the first time they heard Bitcoin when it wasn't being denigrated in the press was in November when we announced, and we all know that it takes some time to get used to the idea. We've been doing the best we can in terms of, me getting out there, other people getting out there, being open to training sessions, stuff on LinkedIn. I was on a call this morning where there were about maybe 20 or 25 mixture of different people across the industry, some trustees, some other advisors, and it was an educational session. That's very much the way that I wanted it to be. Some of them, we had a whole range of different people on that call. So we had, from the point of view where they're never going to understand it, for want of a better, I'm trying to think how to describe it as diplomatic as possible. They're never going to get it. And that's fine, right? Some people are not. And then at the other end, someone who was much younger and you could tell from some of the language that he was using that he'd clearly done some reading. I would guess that he's almost certainly read some Sefer Dinamus. And that's quite interesting. And then there's a whole range of people in the middle, probably. This is a really important issue. You mentioned earlier about when you go onto one of the apps that there's a message that comes up, which is obviously a regulatory requirement that someone may lose all their money. I don't get that on my banking app. I think I probably should. If I have pounds or any government currency, there is a non-zero risk that I will lose all my money. And you could argue that, strictly speaking, it's lose all my purchasing power rather than units of the currency. Fine. Happy to make that distinction. But there is a non-zero risk. The more I dug into Austrian economics and all those things, even just business cycle and so on, you realise that it's not just non-zero, it's potentially a material, meaningful risk. And that's why I think a lot of people move from saying it's not risky to have some Bitcoin, it's risky to have none. But the point being that it's once you start understanding, well, I've got these different types of money, which ones do I actually want to have exposure to? Which ones are there ones I don't want to have exposure to? It then gets really quite, it's quite interesting then.
Yeah. And the thing is, if some of these companies are putting in even as low as 1 or 2%, the reality is if Bitcoin fails and goes to zero, that probably extends the horizon of their investment. Before they can hand it over to an insurance company, it might extend it for another year or 2. to close that gap that they've lost through buying Bitcoin. But if it does the opposite and the 1 or 2% goes to 5, 6, 7%, they could be bringing it forward by 5 years, 10 years, or, so
Yeah.
it's the asymmetric risk thing, isn't it? It's not like they're putting, like we discussed earlier, they're not putting 20% in and really exposing that fund to more risk than they should. They're putting a very small amount in, with it being almost like an insurance policy, but it's not an insurance policy. It's a genuine hedge that could give them a great return.
Yeah, no, exactly, and that's actually exactly one of the tests that we did do, because our industry is very good at coming up with lots of complicated ways to calculate risk, and we did those, of course. But what I was also keen to do was to make sure that we measured the risk in a way that actually directly reflected what their objective is, and their long-term objective is to hand over the scheme to an insurer, and that came to about 10 years. And then we did Bitcoin go to zero, went to 10 years, 3 months. So it's obviously worse, but not dramatically worse. And then we did, well, what if it goes up in line with some best estimate assumptions? And then it knocked off a couple of years. So you got 3 months one direction, 2 years the other direction. And obviously people could come up with different assumptions, come up with different answers on that. But it's exactly that asymmetric situation that we did really well of highlighting.
Yeah. And that's where a lot of individual purchases of Bitcoin will come in on a similar scale, is to think, I mean, it sounds like to some extent that's how you got into it in the early days, was you thought, well, it might go to zero, but if I dabble with a little bit and it doesn't die, because it hasn't died yet, then, the risk of what I'm going to lose isn't that much, but the return could be quite significant. As much as the individual unit price of Bitcoin is now, exponentially higher than what it was 10 years ago, those rules of, investing a small amount limits your downside risk, but still gives you plenty of potential for the upside should Bitcoin continue to do what it has done, fact, or what certain people are projecting it will do going forwards. And most of those projections are softer than the historic rises we've seen, for good reason, because, again, as we discussed earlier, the risks now are lower of it going to zero, of it breaking, of it falling apart. So potentially the upside gains are lower than they will have been in the past, but they're still, compared to any other asset class, they're higher, aren't they? There's no one that's projecting Bitcoin is going to, on average, grow at a lower rate than anything else on the planet.
It's going to be very difficult to find anything. There'll be some individual stocks that do better for very particular reasons.
But that's hindsight reporting, isn't it? That's saying in 5 years' time, you might be able to look back and go, well, if you'd bought, Blogs Limited in 2025, that went up 50,000%. Well, that's needle in a haystack time, isn't it?
Yeah, exactly. Benefit of hindsight and all that is easy, isn't it?
Yeah, yeah. Well, I think I could probably continue talking to you for hours and hours about all of these things that I find massively riveting, and I think you do too. But for the sanity of the listener and our families, we should probably draw our conversation to a close. The last question I ask all of my guests is, what's one belief you held before Bitcoin that you've completely changed your mind about?
Why would government act against us? There's no reason for them to do that. And then I learned more about history and money, and I mean history, not just about money, and there's lots of stuff I don't know, but it then became very clear that government often doesn't have our best interests at heart, which is a real shame, because life would be a lot easier if they did. And that then leads directly to, well, why would governments devalue the money in our pockets if they got our best interests are? Well, they've got their own objectives. They do their own thing. That takes precedence over what you or I think about or care about. And so that's where some of the early adoption, I think, an early majority comes from, is they sort of look at it as, actually, I'm not comfortable. I'm not comfortable with this anymore. I'm going to do something that's different, or is going to try something else. And there's quite a good cartoon that, well, I think it's quite good. I think it's quite good. I think it sums it up quite well, the reality of a situation. And this doesn't just apply to Bitcoin, this could apply to lots of different things, where you have a cliff and you've got a plank that's hanging mostly over the edge. And on the bit of the plank that's on the cliff, you've got a group of people. Let's say you've got 20 people. And then on the end of the plank, you've got someone with a pulpit and they're standing behind and there's a speech bubble there and they're preaching at the people, at the crowd. And depending on what particular topic is being talked about, then might depend exactly what's in that bubble. So people have seen that. Anyway, so the point is that there's one person, back to the crowd end of the plank, there's one person that's stepping off the plank and saying, F this, essentially. And what it is doing is saying, well, actually, there's the reason why fiat currency still has value is because people keep using it, even though it is undermining them every day in what they do. And some people are going to get fed up with that quicker than others. And what I love about Bitcoin is actually that we don't, and we shouldn't either. I would not advocate violence. We shouldn't be standing up and trying to fight, picketing outside the Bank of England or anything like that. Just walk away, just don't use their money. And they'll stop abusing you. Wow,
I love that. That's great. So if people want to reach out to you, Sam, where's the best places to find you?
So LinkedIn is probably the best place on social media to find me. I was a bit quieter last month, but I try and be relatively active, and there's always stuff going on. So it's good fun sometimes.
Great. Okay, well, thanks again for being on. I really enjoyed our conversation, and we might have to do a part 2 at some point, I think.
Pleasure. Thanks so much, Gary. Appreciate it.
Cheers. Thanks, Sam.